Our guest says that with U.S. stocks near a record highs, there is support from the U.S. economy, despite all the worry about tariffs, etc. U.S. GDP continues to chug along, powered by government spending. Let's get more from Cole Smead, CEO and Portfolio Manager at Smead Capital Management. Cole, thanks very much indeed for joining us. So, insofar as the stock market is driven by the U.S. economy, do you think the U.S. economy looks okay right now?
Yeah, and thanks for having me, Andrew. The answer is yes. That's been really, you were just commenting on the lows of oil. If you go back and look at oil, really it's economic fears that's been driving a lot of the stocks, because obviously the stocks did not low at the same time as the price of oil. And I think that's been the dominant trait of call it economically sensitive businesses, or ones that are tied to economic optimism like the energy stocks, is that ultimately there's just been a bunch of bears out on the U.S. economy for quite a long time. This is not the first time. It happened in 22 as well. And this just seems to be the economy that can't be stopped. And like you mentioned, fiscal spending is causing a major stabilization and a buffer in the economy. And until that ends, it's very tough to see how the economy can't grow.
So the rally in oil, obviously there's multiple factors in the Middle East. You have an interesting observation, though. Perhaps the Saudis knew in advance of the Israeli attacks on Iran, and that's why the Saudis were keen to, or were willing to, put more production onto the market to help ward off a surge in prices.
Yeah, I mean, if you go back and you look, Israel and Saudi Arabia were going to normalize relations for the first time really ever. And then Gaza took place and really stymied that, which was obviously, led by Iran and their proxies. You fast forward, you would get to early this year, out of nowhere, the tight supply that OPEC Plus had been maintaining turns into, we're now going to grow production and meet what they called the demand. And everyone's looking and saying, what in the heck do they mean by demand? And ultimately, you look back now, and you'd think that there was a conversation between MBS and the Trump administration where they very much knew what Israel was going to do. Now, I don't know that, but it all seems to line up a lot better than the production increases that started in the spring into what was kind of a weak market, if you will. Now, that being said, here's the other thing that was in place. I mean, you know this, Andrew. You've had everybody come on your show and say this. There was more bears on the price of oil in April than I've probably ever seen as an investor in the space. And what's happened is this is a tear your face off rally for the professionals that got bearish really for two reasons. One, those production increases, but two, again, they were pretty negative about what could happen in the U.S. economy, and that is a pretty good proxy of global economic growth. And so I think it's been a kind of a two-part rally. I think the other thing it exposes is, back to the S&P 500 and U.S. stocks. We think the S&P is going to do terrible over the next 10 years. I think commodities is going to beat the S&P 500, but it also exposes the risks that you don't have to take. You don't have to take beta risk to make money the next decade. You can take other forms of risk like commodity risks. You can take geopolitical risks and get rewarded for those. And that's exactly what places like the commodity markets and or oil, energy stocks provide. And that you don't get that in other parts of the stock market right now. So
just give us your thesis there again, Cole. You think commodities may offer better returns than stocks over the next decade, did you say?
Yeah, in other words, paper assets, in paper assets being things trading on hopes and dreams, really fiat prices that are out there where you can go out and find, it's dime a dozen to find U.S. stocks trading for free cash flow after you count their stock-based comp from anywhere from 40 times free cash flow all the way out to 200 or 300. That's very common in a lot of the hype stocks today. Now, names like Nike and other names like that have fallen off. DocuSign's another example. But that's not what's driving the U.S. stock market. 42% of trading volume in the United States right now is penny stocks. Zero-day options have gone off the charts. This market is waiting for a reckoning in the S&P 500, and you compare that against what's going on in the energy stocks in that market, or north of the border, the energy stocks in the TSX, and it's stock pickers heaven. In many cases, these are all a buy. The question is who's going to make the most money. And I think that's really what we're trying to ascertain. We continue to find opportunity in that space. We were out in the last month buying Tamarack Valley Energy for the first time. We've tended to be a long reserve life player and want to own really good assets. And I think what we're seeing is there's good capital allocation showing up in some of the less liquid names. That's not true for all of them, but we're eventually going to roll this industry up. And I just think that the prospects for what's going on are really incredible, especially when the professionals get as bearish as they did in the space.
You have MEG Energy is one stock you're watching, the company defiantly rejecting the hostile or at least unsolicited takeover approach from Strathcona. You think it's unlikely MEG will find another suitor?
Yeah, the go-it-alone approach seems very implausible because the market didn't like that approach before the offer. They were effectively treating MEG like they had something wrong. Wrong being that they were doing a great job of buying back stock. You know, again, their capital allocation overall, we don't disagree with, and we think the management did a really good job. The difference, though, is they don't have an anchor shareholder, a large capital allocator like Adam Waterous brings to the table. So I just point that out because ultimately, when I went through their deck, you know, their rejection proposal that they provided yesterday to shareholders, going through that deck, it just says one thing. If you'd like to provide us a better offer, please come with it, and we will discuss it and talk about it. And they're up for sale. There's no doubt about that. The question is what price and who's the buyer. And you know, in our opinion, we just don't see another buyer out there.
Not one. I mean, it is one of the last high-quality oil sands assets, though, that could go to a strategic purchaser. Is there not a scarcity value for MEG, though?
There's just not an aggressor out there, Andrew. This is the low T era of the energy business where it's hard to find testosterone and machismo. It's just greatly lacking in the space. And I think that's, you know, the aggression that Waterous is taking is exactly what's missing. I mean, again, like I just mentioned, you know, we're out buying Tamarack Valley Energy. There will be some point in the next 5 to 7 years that there will be a buyer for that too. We're going to roll this industry up into 4 producers. You know, if I had to guess, those 4 producers are going to be Strathcona, it's going to be Imperial Oil, it's going to be Suncor, and you're going to have one other sitting out there, you know, ultimately, and you know, that's going to kind of be the market with CNQ as the 4th. And so that's where we're going, and that's what the Canadian oil space is going to look like. And by the American space, it's going to look very similar. We're probably going to have 3 on the American side. Look at the railroad industry as a paradigm for this, Andrew. How many railroads are there in Canada? How many railroads are there in the United States? This is a mature business. It should have rational capital allocation and very few players. And that's a good paradigm for understanding where the oil business is going. Funny enough, in Canada, some of the oil businesses came out of assets originally in the railroad businesses. So again, it makes a lot of sense, and the symbiosis there should be really present.
Yeah, that's right. The two industries share such a heritage. Yeah, the regulator in Texas is the Railroad Commission, isn't it? Yeah, the oil regulator.
Correct.
The interesting thesis, the Globe and Mail reporting today, Andy Willis quoting RBC as saying that the Trans Mountain Pipeline expansion, by moving oil to Asia more readily, has permanently narrowed the discount on Canadian heavy crude. And that, of course, tends to increase the value of MEG, which is a particular winner, apparently, from the pipeline expansion.
It is, but I think what you're going to see is the WTI WCS spread of the past is gone. We're not going to see regular $15 to $20 spreads and big blowouts above 20. You can still have blowouts, but we're just not going to see what we had prior. So the idea of, say, like an $8 to $12 spread, I think the one thing that the market's picking up on, and that's why you're seeing the spreads come down, is the Carney government will be doing east and west pipelines. And so the pipelines in the future are going to compete for pricing, which is going to cause the producers to earn more than they did in the past versus the more restrictive pipeline regime that was true during the Trudeau government. So I think that's a distinct change from the past. You know, why is my theory on that? I mean, Carney's an infrastructure guy coming, you know, out of the Brookfield space, and that's, you know, he would have a lot of colleague and people with a lot of understanding. Obviously, Hodgson is going to be the energy minister, and he's present, and he's a Goldman banker. And again, it's more pragmatic than I think people would have assumed coming into a Carney government. And I just think that speaks really well for the industry to go out and get the pricing on the production side versus the pipelines really over-earning like they did for a long time. Would
you be inclined to short Enbridge or TC Energy, the pipeline guys, if their market power is going to diminish, or is that going too far?
Yeah, we're long only. We don't like to make money on other people's misery. That being said, you know, again, I think the other phenomena that people aren't paying attention, and you know, there's been people talking about hedging going out on the desks the last few days on these prices. But if you go look at the volumes in the derivative market, what you're going to find is that, you know, if you're a CNQ, you're a Cenovus, you're a Suncor, you can't go hedge your full book. Who the hedging really benefits for on this price spike is smaller producers, because they could fully hedge 12-month inventory that they're going to produce. And so this market is really going to benefit the smaller production because of what they can do in their derivatives books to meet their needs and pricing. The bigger producers don't have as much flexibility because they can't go out and hedge that much volume.
Just to switch from energy, Cole, but we could talk to you about that all day. You are seeing some interesting ideas in real estate and house building. For example, Lennar, that's a stock that you own currently.
Yeah, Lennar reported earlier today the news was effectively not as bad as people think. And so, again, back to the economic optimism picture, there's people put a lot of clouds around the U.S. economy. The overall general bear thesis there is that mortgage rates are high, no one's going to buy a house. But if you look at supply, we have roughly about the 2019 level of supply. If I go back and check my watch, that was a pretty good 5-year run after that in housing. Ultimately, there's about 5 months of supply meeting demand, and that's on lower demand with those higher mortgage rates. It's been a place that people often have got very negative on. They got negative during the pandemic. They got negative in 2022 when rates went higher. It's been a place for people that bearish. But again, we also own other assets like mall REITs. Mall REITs, you see the consumer numbers today. It's been a place that, we own Macerich and Simon Property Group. That's been another place that people have regularly want to get very negative. And we've just continued to find ourselves in the economic optimist camp like we are in the energy business. And yet the stock market, particularly in the S&P, feels very confident about its hand. And again, we don't short anything, but like I said earlier, I don't think the S&P is going to make money versus all these other kind of Main Street economic optimism stories. I think there's places to make really good returns on capital.
Let's have a look at Simon Property, SPG. You think there was just too much pessimism over malls, as you say?
Yeah, there is, and Simon was less affected by the worries of April and kind of Liberation Day. If you go look at Macerich, they went from $22 early this year to $14 in 3 months. So as people watch the lack of economic nightmare come to the economy, and we continue to scroll on, what you're finding is these economically sensitive stocks they have a bid. There's a real bid there. But again, I think you got to juxtapose that against, I'm not advocating for everyone to go out and broadly buy U.S. stocks in the S&P 500. I think it's going to be tough for the S&P to meet its old high. This looks kind of like 1999, where it's like you're somewhere between March of 2000, where the S&P broke, and August, where it almost retested that high 5 months later. We're in a bear market. This is a bear market rally in the S&P 500, and the places that are making money are the economically sensitive stocks that got punished so much in the spring.
You're watching the Treasury market. Let's put up the U.S. 10-year bond yield. So if we get a 5% yield on the U.S. 10-year, it's going to be extremely tough for the stock market.
Yeah, that's the one thing that doesn't make sense. It's like the Treasury buyer, out there among foreign buyers or U.S. buyers has decided that we have a fiscal problem. I call it the 2 big Fs, Andrew, which is fiscal policy and foreign policy. They're the things that are almost impossible to deal with today. And I'd say that for any administration. I'm not picking on the Trump administration when I say that. They're the tough to solve issues. And so we can't fix our fiscal situation. The new tax bill is not going to change that at all. And the bond market seems to be pretty worried about the fiscal situation. And the stock market's out in la-la land thinking nothing will affect it, whether that be foreign policy or fiscal policy. And so just put those two risks against each other. I think there's absolute complacency among the average stock investor. They've effectively looked and said, close your eyes and the chart's going to go up and to the right. And that's not how stock markets work. The stock market was not formed to get everyone rich. And anyone thinking that is often going to get punished. That being said, pair that against what we talked about in the energy business. You had to kind of look into the whites of people's eyes in the spring here, and that shows you really where the more attractive risk rewards are out in the U.S. stock market. And I would say that applies for that same space in the TSX as well.